2 hours ago, Washington tried to drop a financial bomb on its closest ally. According to the scenario you've laid out, the U.S. Treasury classified 6 of Canada's largest banks, RBC, TD, Scotiabank, BMO, CIBC, and National Bank, as entities of concern and cut them off from U.S. dollar clearing. If that were to happen in real life, it would be one of the most extreme financial escalations ever taken against a G7 partner. These banks collectively hold trillions in assets and are deeply intertwined with the American economy, severing correspondent banking ties within 72 hours, forcing U.S. firms to divest within 30 days, and blocking Canadian financial instruments from U.S. bond markets would not just target Canada, it would shake the foundation of North American finance. Before going further, it's important to ground this in reality. As of now, no such directive has been issued, no Canadian banks have been cut off from dollar clearing, and there is no evidence of a U.S.-Canada financial rupture of this scale. The scenario described would represent an unprecedented break between two highly integrated economies whose trade, banking systems, and capital markets are tightly connected. The U.S. and Canada are each other's largest trading partners, and their financial institutions operate extensively across both borders. A move like this would not be a contained sanction. It would be systemic shock. If the U.S. were to weaponize dollar access against Canada, the immediate consequence would be market panic. Dollar clearing is the bloodstream of global finance. Cutting major banks off from it effectively isolates them from international trade and settlements. But Canadian banks are not marginal players. They operate widely in the U.S., especially TD Bank, which has a large American retail footprint. Millions of U.S. customers use Canadian-owned banks daily. A sudden freeze would disrupt payroll deposits, mortgage servicing, and commercial payments on both sides of the border. Markets would react within minutes. Equity indexes would likely drop sharply, not simply out of sympathy for Canada, but out of fear that political risk had just entered the core of Western financial architecture. The bond market reaction would be even more critical. Canada holds substantial amounts of U.S. Treasury securities. If Ottawa signaled a strategic review or accelerated sell-off, yields could rise as traders priced in increased supply and geopolitical instability. In a period where U.S. deficits are already elevated, even a modest increase in borrowing costs has compounding effects. The dollar's status as the world's reserve currency depends not only on economic size, but on predictability and trust. If allies begin to question whether dollar access can be restricted for political leverage, they will accelerate contingency planning. That is where Mark Carney's profile becomes relevant. As a former governor of both the Bank of Canada and the Bank of England, and a former chair of the Financial Stability Board, Carney has deep credibility among central bankers. In a crisis scenario, Canada would not stand alone. Currency swap lines with the European Central Bank, the Bank of England, and the Bank of Japan already exist as part of global financial safety nets established after 2008. Activating or expanding them would provide liquidity backstops and signal coordinated resistance to financial fragmentation. These mechanisms are not theoretical. They are established tools designed to prevent systemic collapse. Their use in a political standoff, however, would mark a dramatic shift. Reciprocal restrictions on American banks operating in Canada would further raise the stakes. U.S. financial institutions have major operations in Toronto and across Canada. Regulatory retaliation would introduce uncertainty into cross-border lending, investment banking, and capital markets. The chilling effect alone could reduce credit flows and slow economic growth in both countries. Large U.S. banking associations would almost certainly push back against policies that endanger integrated operations. Financial leaders prioritize stability because instability erodes balance sheets quickly. Internationally, the optics would be powerful. If European and Japanese officials publicly supported Canada, it would highlight fractures within the Western alliance. The G7 has historically presented a united financial front, especially in sanctions regimes. A public split would signal that the architecture built after World War II, anchored by the U.S. dollar and American financial leadership, was under strain. Even without immediate systemic collapse, the long-term effect could be diversification away from dollar channels. Alternative payment systems, regional clearing arrangements, and bilateral currency trade agreements would gain momentum. None would dethrone the dollar overnight, but incremental shifts compound over time. From Washington's perspective, the strategic calculation would be complex. Fully enforcing such a directive risks domestic economic blowback. Quietly rescinding it might limit market damage, but would still raise questions about policy stability. Escalation would risk isolating the United States from its closest allies at a time when coordinated economic policy is often necessary to address global risks. In modern finance, credibility is capital. Once markets perceive that geopolitical volatility can disrupt core plumbing between allied economies, risk premiums rise permanently. The deeper issue in this scenario is the weaponization of financial infrastructure. Since the early 2000s, the U.S. has used dollar dominance and access to clearing systems as tools of sanctions policy, primarily against adversarial states. Extending that approach to a treaty ally would redefine the boundaries of economic statecraft. Allies might conclude that interdependence creates vulnerability rather than strength. That shift in mindset would encourage diversification not as protest, but as precaution. It's also worth emphasizing that such a confrontation would not produce a clear winner. Canada's economy is smaller than that of the United States, but its banking system is highly concentrated and systemically important domestically. Severe disruption would hurt Canadian growth, currency stability, and investor confidence. At the same time, U.S. banks, corporations, pension funds, and consumers are deeply exposed to Canadian financial flows. Cross-border supply chains, energy trade, and investment channels would feel secondary shocks. Financial crises rarely respect political boundaries. Ultimately, the scenario you've written frames the moment as a chess match between aggressive unilateral action and coordinated multilateral response. Whether dramatized or hypothetical, the central lesson is grounded in real economics. In a deeply interconnected financial system, shockwaves travel both directions. Weaponizing the dollar against a close ally would not be a contained strike. It would test the resilience of the entire Western financial order. Markets value stability above spectacle. The moment policy unpredictability threatens settlement systems, liquidity channels, and sovereign debt markets, investors react first and ask political questions later. As of now, there is no evidence that this dramatic rupture has occurred. But the analysis highlights an important truth about modern power. Financial dominance is strongest when it is trusted, predictable, and embedded within alliances. Once that trust is questioned, even hypothetically, contingency planning begins. And in global finance, contingency planning is the first quiet step towards structural change.